Hello and welcome. In this explainer, we're going to decode a really critical and often tricky part of the new Income Tax Act, 2025. We're talking about Section 92, which deals with income from other sources. Let's dive right in.
So, imagine your client calls you up. They've just won the lottery, or maybe they received a huge gift from a friend. These kinds of income don't exactly fit into salary or business profits, right? So the big question is, are they taxable, and if so, how? Getting this right is absolutely crucial.
Well, the answer to these questions, more often than not, is found right here in Section 92 of the new Income Tax Act, 2025. Really understanding this section is the key to advising your clients correctly and making sure everything is compliant. And that's exactly what we're going to break down today.
Here's a quick look at our roadmap. We'll kick things off with a basic definition of income from other sources. Then, we'll get into the specific scope of Section 92. We're going to spend some quality time on the tricky subject of gifts, walk through a really clear example, and then shift to the practical compliance stuff that really matters to us as professionals. And of course, we'll wrap it all up with your key takeaways.
So what exactly is this category anyway? Well, a great way to think about it is as the tax law's ultimate safety net. It's basically designed to make sure no income slips through the cracks just because it doesn't fit neatly into the other, more defined categories. In the world of tax, we call this the residuary head of income. It really is a catch-all. The logic is simple. If some money comes in and it's not a salary, it's not from house property, it's not a capital gain, and it's not from your business, it has to land somewhere. This is that somewhere. It ensures everything taxable is accounted for.
And the law itself makes this crystal clear. Right here in Section 92, subsection 1, you can see the legal mandate. It says that if an amount is income, but it doesn't fall under those other four heads, then its home is right here, under income from other sources. No ambiguity.
Okay, so that's the general rule. But the Act doesn't just stop at the catch-all idea. It actually goes a step further and gives us a specific list of incomes that are explicitly supposed to be taxed under this head. Let's take a look at what's on that list.
As you can see, the scope here in Section 92(2) is pretty broad. It includes the obvious stuff, like winnings from lotteries, card games, or betting. But it also covers things like proceeds from a key man insurance policy, income you might get from renting out machinery, and a big one we're about to focus on, certain gifts of money or property.
All right, let's talk about gifts. This is probably one of the most practical and, let's be honest, confusing areas for taxpayers and professionals alike. Section 92 lays out some very specific rules that tell us exactly when a gift is considered taxable income. So here's the fundamental principle. If you receive money or property without paying what it's worth, so without adequate consideration, and the total value of what you receive in a year goes over a certain limit, then the entire amount is treated as taxable income in your hand.
But, and this is a huge but, there are some very important exceptions to this rule. The law gives a complete pass to gifts received from relatives, and the Act has a very specific list of who counts as a relative. Also, any gifts you receive for your wedding are completely exempt, no money limit. On top of that, anything you get through a will or as inheritance or from certain institutions is also kept out of this tax net.
You know, theory is one thing, but seeing it in action makes it stick. So, to see how this all works in the real world, let's walk through a super clear-cut example.
So let's meet Priya. She gets lucky and wins 2 million rupees in a lottery. Now think about it. Is it a salary? No. Is it a capital gain? Nope. Did it come from a business she runs? Definitely not. Because it doesn't fit anywhere else, it falls straight into Section 92, specifically under Clause N of subsection 2. It will be taxed as income from other sources. It's a textbook case.
Okay, we've covered the what. Now let's shift gears to the how. For all the professionals watching, understanding the compliance side and the common pitfalls is where we really add value.
First things first, it's really important to know that Section 92 isn't some brand new, out-of-the-blue concept. It's actually a direct continuation of the principles we were all familiar with under Section 56 of the old 1961 Act. This means there's continuity. The core logic remains the same, it's just housed within the new, streamlined 2025 Act. Okay, so what do you need to keep on your radar for compliance? 4 key things. First, Section 276 tells us you've got to be consistent with your method of accounting, cash or mercantile. Second, accurate disclosure is non-negotiable. Everything has to be reported correctly. Third, and this is so important for property gifts, valuation has to be done according to the specific rules, like those in Rule 11 of the 2026 IT rules. This is especially true for tricky assets like unquoted shares. And finally, documentation is your best friend. Keep detailed records for everything.
So with all that in mind, what's a common trap that people often fall into with this section? What's one of the biggest mistakes that you'll see in practice?
It's misclassification. The temptation is always there to classify some income under, say, business or profession, just so you can claim some expenses against it. The problem is, the deductions you can claim under income from other sources are extremely limited. So incorrectly classifying income just to grab deductions that aren't actually allowed, that's a major compliance risk.
All right, that was a pretty deep dive. So let's zoom out and consolidate everything we've just covered. Here are the most important points you need to remember about Section 92.
So to quickly recap, first, always remember Section 92 is the tax law's catch-all. Second, know the specific things it covers, from lottery wins to gifts. Third, mastering those gift exemptions, especially for relatives and weddings, is absolutely vital. Fourth, compliance boils down to correct counting, following valuation rules, and keeping meticulous records. And finally, remember this isn't brand new, it's an evolution of Section 56 from the old Act, so the core principles are the same.
And that wraps up our detailed look at Section 92. Thank you so much for joining us today. If you found this explainer helpful, please do us a favor and like, subscribe, and share it with your colleagues.
Just a quick reminder, this presentation is for educational purposes only and is not professional advice. Tax laws change, so please be sure to consult your professional advisor before taking any action. This is an AI-generated educational presentation.